As the nation's energy bills go up, with the expiry of the last price cap, council tax bills rise, and the national insurance contribution increase on earnings above £9,880 kicks in, at least for 3 months, everyone could be forgiven for looking at the latest UK wage growth and inflation figures with some degree of trepidation. The wage figures will accompany the latest UK unemployment numbers on Tuesday the 12th of April, and the inflation figures are due the day after on Wednesday the 13th. The last data set from the Office for National Statistics, or ONS, covered the month of January, when the jobs market frankly looked pretty rosy. Unemployment was just 3.9%, back to where we were in December 2019, before the pandemic. Employment rose to 75.6%, only a touch lower than before the virus. And wage growth was 4.8% year on year, to an average weekly pay, including bonuses, of £596. However, the good news pretty much stopped there, because inflation was running well ahead of pay growth. According to figures also from the ONS, year-on-year increases in the cost of living looked as follows for the month of February. 6.2% according to the Consumer Price Index, or CPI, the highest figure since that measure was introduced in 1997. 5.5% according to CPIH, the Bank of England's preferred measure because it includes housing costs, but it may also quite like it because it seems to give a consistently lower figure, and 8.2% for the Retail Price Index, or RPI. Now, RPI is no longer an officially recognised statistic, I must stress, but that RPI reading was the fastest rate of increase since March 1991, when, lest it be forgotten, the Bank of England base rate was 12.375%, rather higher than the 0.75% level to which the Monetary Policy Committee meeting took the headline cost of borrowing at its meeting in March. Central bankers, politicians, economists, and the great British public will be hoping for some relief from both sets of figures, although that may unfortunately be a little bit unlikely, at least in the near term. The Office for Budget Responsibility is warning that inflation will average 7.4% in 2022, and Bank of England Governor Andrew Bailey is calling in turn for pay restraint, so as to avoid a 1970-style wage spiral, though that's not a message that may go down too well in many households. After a fairly quiet time of it last week, corporate news flow is about to step up a gear, not least because the first quarter reporting season in America is already upon us. JP Morgan Chase will be first up to the plate on Wednesday the 13th of April, quickly followed by Citigroup, Delta Airlines and Alcoa on the 14th. On this side of the pond, 2 FTSE 100 firms are set to release full-year results, and there's a good number of mid and small cap firms slated to release final, interim results or a trading update. Names which may be worthy of further research include the following, although some of these dates could yet be subject to change. JD Sports Fashion, Pennon, EasyJet and Ferrexpo on Tuesday the 12th of April, Page Group and Lookers on the 13th, Dunelm, Mediclinic, Hayes and Ashmore on the 14th to close out proceedings ahead of the long Easter weekend. But the company which could just cause the biggest fuss in the week ahead is Tesco. The grocery giant set to publish full-year results at the end of February on Wednesday the 13th of April. The shares may be some 10% off their highs, but they're up by around a fifth over the past 12 months. This may be partly because the firm's seen as holding market share in the fiercely competitive grocery business. According to consultants Kantar World Panel, Tesco's market share is flat at 27.4% over the past year, whereas Sainsbury's, Asda and Morrison's have all seen declines as Aldi and Lidl in particular have continued to gobble up share. More widely, it may be because we all have to eat and sleep and keep our houses clean, and as a key provider of consumer staples, Tesco may have a bit of pricing power, especially given that market share. At a time when inflation is a key concern, and customers may start to trade down or even buy less, this could be a useful part of Tesco's armoury when it comes to driving profits and cash flow and protecting profit margins. Now, looking at the full year results, analysts and shareholders will look to 4 key numbers. The first is like-for-like sales growth in the fourth quarter. At the third quarter stage, group like-for-likes were up 2.4% on a one-year basis and 7.9% against 2 years ago. Online sales were a key factor here, but the UK was up year on year. Wholesale business Booker was roaring back with a 16.2% advance, and even Central Europe was up 3%. On a headline basis for the full year, by the way, analysts are looking for total sales of £61.2 billion against £59.9 billion a year ago. Now, the second figure is operating profit. At the time of January's Christmas update, Chief Executive Ken Murphy steered adjusting operating profit from the retail business estimates towards the top end of the range of $2.5 to $2.6 billion, with Tesco Bank expected to add $160 to $200 million on top of that as loan losses fell. As a result, analysts are looking for adjusted operating profit of £2.8 billion against £1.8 billion a year ago. Also keep an eye open for any guidance here for the year to come to February 2023, when analysts are currently looking for a flat outcome at £2.8 billion. The third figure to watch is operating free cash flow, where Tesco has a target of generating between £1.4 and £1.8 billion a year. And the fourth is cash returns to shareholders. Mr. Murphy has refined Tesco's capital allocation strategy, putting investment in the business first, with capital investment running at between £900 million and £1.2 billion a year. Then next in line comes maintaining a strong balance sheet, then comes the dividend, then acquisitions, and finally buybacks. On that note, Tesco is actually currently running a £500 million share buyback scheme, and analysts are looking for a dividend of around 10.9 pence a share, up from 9.15p last year, based on the grocer's target payout ratio of 50%. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next week.